weather. So I do appreciate your time here this afternoon. So what I want to do is I want to jump right into my remarks on the U.S. economy. Specifically, we're going to look at the U.S. economic outlook. We're going to spend some time talking about the Federal Reserve and fiscal policy, simply because, as we're going to see this year, and probably for the next few years, that policy is going to be one of the major drivers of growth. Now, for many of us who came of age in the 80s and probably joined the banking industry in the early 90s, we're used to more free market, atomistically driven sources of growth. Well, after the great crash and the recession, policy's playing a much more important role, and I think it's important that we stop and discuss fiscal policy and Federal Reserve policy this year. Now, what we're seeing here early in the year is we're beginning to see in the data, as you all saw over the last month, the remarks from Walmart specifically asking where the revenues and the customers were. Well, they're not there primarily because what we're seeing is the impact of the resetting of the payroll tax from 4.2 to 6.2%. We're also seeing an increase in tax hikes. And we're going to begin to see over the next 3 quarters, but primarily clustered at the end of the second quarter and early into the third, the effects of a slowdown in government spending. Now, on a nominal basis, this will create a 2% drag on the overall economic growth, or roughly about 0.8% on a year-ago basis. Now, the big thing that we're watching is what the Federal Reserve is doing, because the Federal Reserve has designed policy for an economy that's caught in a liquidity trap. Now, for many people who don't follow the esoteric monetary policy that the Fed's now implemented, may be a little shocked, because if you turn on financial news television, Bloomberg, CNBC, Fox, you're going to hear a narrative about the economy, an economic recovery, the economy's gaining steam. But if you read what the Federal Reserve is writing and what they're communicating to those on the sell side, and economists like myself, it's a very different picture. It's an economy that's got significant long-term upside, great potential, but in the near term it faces substantial challenges. While you're going to get to see a little bit of both, we're probably going to focus a little bit more on those challenges, because it does tell us what the Fed's likely to do probably over the next 3 to 5 years. Now, we're likely to see another year of 2% growth. We should see job creation around 150,000 per month. We may see a little bit of a quicker pace in February, but then the impact of those tax hikes and slower federal spending will likely restrain job growth. Expect to see over the next 3 months a significant increase in furloughs and layoffs having to do with the across-the-board spending cuts. You do know that at the state and local level, we've been in a period of de facto austerity for the past 2 years. You will begin to see the effects of austerity at the federal level for the first time. We do got some great stories though in the economy, right? And you're going to see some of that. First off, energy. Within 3 to 5 years, if we get a little bit of help out of the Obama administration and Europe gets off its back, our trade and current account deficits will disappear. That will primarily have to do with additional resource discovery of energy here in the United States. If we don't get any help, well then in 5 to 7 years. But the point is that there are some good long-term things happening. Here in the manufacturing sector, which I see here in the upper Midwest, we haven't quite seen a renaissance, but the reworking of labor contracts, the integration of advanced technology into the production process has really stimulated a boost in overall productivity, and over time we will see a manufacturing renaissance. You know, one of the great things about my job is I get to go around the country and I get to visit all the banks, all the hedge funds, and I get to go to really big multinationals. And you go to a place like Thrice and Krupp and their manufacturing plant down in Alabama, and it's state-of-the-art. And they located it there because they can take advantage of the cheaper energy resources. And you see other big firms from China beginning to make foreign direct investment or building plants here in the United States. And you will begin to see an economy that really, the model behind the growth that we see will be transformed to one that was primarily dependent upon easy credit and overconsumption, to one that's moving towards a growth model that's based on energy, technology, and value-added manufacturing. In short, this is part and parcel of the great global rebalancing that we're processing through. It's a structural adjustment. It's going to take a number of years. But essentially, the U.S. is going to save more and produce more. The Chinese are going to save less and purchase more. Now, the other thing that we're seeing, and we'll spend some time on it in the presentation, is financial conditions have improved significantly, not only here in the United States, but in Europe. And that's directly a result of what the big central banks are doing. And indeed, this is part and parcel of the longer-term recovery that we're now engaged in. There are risks to the outlook. Again, what's going on in Europe, as we saw with the no decision in the Italian elections. And of course, we've got the German election coming up later this year. That does present a very large risk to our own economic outlook. Anybody who's paying anything attention to what's going on in the Middle East with Iran and oil prices, that's fairly clear. That's a big outlook, a risk to the outlook. And then, of course, financial regulation here. Actually, we do need at one point clarity on what Dodd-Frank means and how it's going to be implemented. Now, my sense is that that risk is diminished largely due to the hiring freeze that's going to go on in the federal government. We're just not going to be able to hire the number of bodies and a number of bodies with expertise to implement many of those regulations that we don't quite yet know in Dodd-Frank. I'm going to spend some time here on the next couple charts. These are what I call my mind the gap charts. This chart here shows the relationship between jobs and growth. It's got a very strong, statistically significant relationship going back a number of decades. And what it shows is that the economy continues to underperform. You've got an economy that's roughly capable of growing at around 2%. Historically, if you saw job creation between 150 and 200,000 a month, you should have a rule of thumb that tells you 3% growth. I know lots of economists out in the middle of the country still hold to that. But because we've had something of a structural break in our labor market and in the broader economy, especially in the household and the level of consumption, we're not likely to get that outcome. So you should expect, over the next couple of years, to see growth roughly at around 2%. Or as I like to call it, we have a 2% economy. Why is that? Well, we have a fairly significant output gap, right? We're not producing at the capacity at which we're capable. We have an output gap at roughly about 6%. What that means is we're foregoing around $800 billion in goods and services that we could produce per year. One of the reasons why the Federal Reserve has implemented the policies that they have had, and why they will continue to probably through 2016 and 2017, is they want to close these gaps. And indeed, if these policies don't gain traction, you should expect another round of policy innovation out of the Fed, and we'll get to that. Now, this is the chart for me. This is the only chart that matters. I've got three areas of special expertise: monetary policy, labor markets, and the condition of the consumer. For me, this is the chart. What you're looking at is a relationship between the employment to population ratio and the official unemployment rate. The unemployment rate is on the right-hand side, the employment to population ratio is on the left-hand side, and the employment to population ratio is inverted, not the unemployment rate. But that gap, you see that gap there? After many years of very tight fit, robust, statistically significant fit, that's where the 12 million people who are unemployed, and that's where the 13 million people who are underemployed live. That gap is our labor slack. When you hear about substantial resource underutilization or labor slack, this is a very good visualization of that. What this tells me is that the official unemployment rate's around 7.8, 7.9%, but the real unemployment rate's closer to 10.5%. When the Federal Reserve talks about setting an employment threshold of 6.5%, and they're pledging to buy assets until they reach these thresholds, what they want to see is that gap begin to narrow substantially. Right? This is sort of where economists can really provide value out in sort of greater society. We have a lot of politicians who like to talk about recovery, who like to talk about success, but the data doesn't lie. As you can see, this relationship goes back a number of decades. And so when you're thinking about long-term investment, when you're thinking about how the economy is likely to perform in the near term, what this tells you is that we're just not employing enough people. Our households are just not earning enough money to return to the patterns of growth and consumption that occurred prior to the Great Crash. Something to think about as you make your own investment decisions. This is the gap in real consumption. The blue line is the gap in real personal consumption expenditures trend prior to the recession, and the orange line is where we're at now. This gap is around 9.3%. I'm not sure that this gap's going to be closed in this business cycle. I mean, I'm pretty sure it's not, or even the following cycle. This is likely to take about a decade to close. The gap's 9.3%, and in terms of just spending in the service sector, it represents around $500 billion. If you look at it in a larger macro sense, overall consumption, it means we're foregoing about $900 billion in spending each and every year. Now again, I know many economists who work at banks come out and they tell you why you should be buying, and there's always a sunny side up. I want to show you the real condition of the economy following the great crash and the recession. And this tells me that it's going to be many years before we get back to where we were prior to the great crash. And this also tells me that no one should expect the consumer to fuel the remainder of this business cycle. That it will probably be the next business cycle before we see consumption move higher in a way that makes us recall what the economy looked like prior to the recession. Okay, so our cyclical growth outlook. Expect below trend growth. Trend is 2.5% if you believe the Federal Reserve. We've got a liquidity trap. Liquidity injections in the banking system have failed to stimulate the kind of growth and employment back to trend, which is why the Fed's moved towards the more aggressive policy. We are targeting a liquidity trap, and because of policy gridlock in Washington, of course, when you're in a liquidity trap, the appropriate policy response is fiscal, not monetary. But that's why the Fed's doing what they're doing, and this is one of the risks over the remainder of the business cycle into the next. So we've got these structural adjustment that's moving, and again, I mentioned the growth model is going to be different going forward. Do not expect easy credit and overconsumption to fuel growth. You're going to have to find opportunities in manufacturing, energy, agriculture, and tech. That's where the outsized returns are likely to be. And we should expect to see a period of public sector deleveraging that's going to go on probably for a period of 3 decades. Because it's going to take us about a policy path trend of around 3 decades to put our fiscal path back on a sustainable footing. And we'll talk a little bit more about that in a minute. And we'll skip to the Bloomberg Consensus Survey of Forecast. Now this is from the elite forecasters that we survey at Bloomberg. You only see this if you have a Bloomberg terminal. And what you can see is there's a little bit of an optimism that later this year we'll have a rebound in growth following the adjustment to the tax hikes and the slower spending on the part of the federal government. I'm a little bit skeptical of that. I think that we're likely to see more of that just in the mid-2s, 2.2, 2.3 later in the year. And you can see, if you look at the 10-year and the 2-year, the bond market's not having any of it. The bond market fully expects to see 1.5 to 2% growth. They're penciling in modest improvement in the overall growth picture with a 10-year rate that's likely to be closer to 2% than 2.25%. Okay, let's talk about this labor market because everything comes back to jobs. Right now, because of that enormous labor slack, that gap that you saw earlier, we've got a low-wage bias in hiring. Over 50% of the jobs created since the start of the recovery have been in 4 low-wage subsectors: leisure and hospitality, healthcare and social assistance, temporary jobs, and in retail trade. In fact, in this morning's Bloomberg Economic Brief, which is my product, it's our sell-side style newsletter. About 50,000 people subscribe to it every day. It's now the biggest newsletter in the industry. I ran a chart which showed that the breakdown in the labor market during the crisis and the recovery after. And what you saw was middle-wage occupations. 60% of the jobs lost in the crisis were in middle-range, middle-wage occupations, and 58% of the jobs gained in the recovery have been in the low-wage service sector. So what you see is you see a middle class trading down. Think of it this way. We had a profound housing crash. You had men who would build homes. They would get paid $25 to $30 an hour. We've got a 2.5 million of them who have yet to find work since the recovery. They're trading down. They're not sitting on the sidelines. They've gone back to work. But what they're doing is they're taking jobs that make $12 an hour at Home Depot or $10 an hour at Walmart. So you get a very different outcome. And one of the reasons why you've seen real personal consumption increase at around 1.5% per quarter is because of the wage losses that the economy's absorbed, specifically in many of the hard hat, blue collar areas of the economy. And again, the data doesn't lie. It provides a pretty vivid and compelling portrait of some of the long-term structural challenges that we face. Okay, and here's another one that I think is very clear. One of the reasons why firms, mid-size firms and large-size firms haven't expanded is because they're worried about aggregate demand. And you can see the long-term relationship, again, between real personal spending and consumer confidence. Consumers are just having a hard time adjusting. Even though inflation's low, we know that for many consumers who've lost ground, remember, real personal per capita GDP is down about 5% since 2007. So even if inflation's low, but the cost of food and gasoline has increased, it does imply a period of adjustment. And this is why you see consumer confidence and consumer spending continue to lag. Let's get to central banks. The Fed has engineered a revolution in central banking because the policy rate is constrained by what they call the zero boundary, or that you can't engineer a negative nominal rate. What the Fed's done is, in order to be accommodative, is to engineer in asset purchases. And they use a series of Taylor-like rules to provide forward-looking guidance that tells them how big the balance sheet ought to be. And we'll have a chart for you here in a minute that you'll see. And I expect asset purchases to continue unabated until the middle of 2014 at the earliest. And I expect the interest rate to be effectively zero to mid-2016. Now, what they're trying to do is they're trying to unclog what economists call the monetary transmission mechanism. Although we've had a real sustainable recovery in housing starts, the glut in homes out in the market and the problems in the housing market has prevented the easy Fed policy that's been put in place from flowing through to the broader economy. And I'll show you a real interesting chart that really shows what the Fed's doing and why they're doing it. I expect the Fed's balance sheet to be $4 trillion by the end of this year, with the risk of going to $5 trillion by the end of next year. And if the Fed policy does not gain traction, they're going to shift to another policy, which is known as nominal GDP targeting. They're going to try to close those gaps by raising the price level. Indeed, over time, if the problems in Washington aren't solved, fiscal gridlock remains, and we don't gain traction in the economy, the Fed will implicitly turn to a pro-inflationary policy that will alter the economic landscape. For those of you who aren't working in finance but who work in the real economy, you build and sell things. You have to begin thinking about this. This is absolutely critical because the head of the Federal Reserve and the vice chairman are openly talking about this. Janet Yellen's been quite open in her speeches. And indeed, over our colleagues at the Bank of England, the new head of the bank, Mark Carney, has testified before the House of Commons that he's indeed thinking about imposing such a policy. This is the cutting edge of central bank policy, and this will likely drive asset prices and growth for a number of years if it indeed happens. What the Fed's done is not well understood. It's not well understood among the professionals of Wall Street. It's very, very difficult to understand what they're doing, and in fact, from my point of view, they haven't been exactly clear. They're explaining it the best way they can, but it's the conceptual thrust of the argument I don't think's been made. So when I go out and talk, I try to break it down, and I say, when you want to understand Fed policy, you have to understand the 5 C's. Remember when we were kids, it was about the 4 R's, reading, writing, arithmetic, right? The 3 R's? Well, for the Fed, it's the 5 C's. It's communications. They're going to use an enhanced communication policy in order to shape expectations and the shape of the yield curve. They've committed. They can't back off now. I know a month ago, most of the financial community was talking about rates going up and the Fed ending. Well, Mr. Bernanke spoke 3 times in the past week and Ms. Yellen spoke once. They pretty much put an end to that. The Fed's not going to be tapering off their asset purchases, and they're going to be in the market for a number of years. Conditionality. Conditionality is very important. They're going to make policy based on real economic conditions, i.e. the unemployment rate threshold and the inflation threshold. Right now, the unemployment threshold is at 6.5%, and the inflation threshold, based on the Fed's forecast, not the real inflation that we see, is at 2.5%. If their policies don't gain traction, I expect the threshold to be dropped from 6.5 to 5.5%, and that would imply the Fed will be in the market for a longer period of time than what my current estimate implies. Fourth, composition. It's no longer about the policy rate. No one should be paying attention to the federal funds rate. You need to be paying attention to the size of the balance sheet and the composition of the balance sheet, i.e. how large the balance sheet is. It's over $3 trillion. The composition, what percentage of it is in treasuries, what percentage of it is in mortgage-backed securities, especially in mortgage-backed securities because that's targeting the problems in the housing market and the monetary transmission mechanism. And then finally, credibility. If the Fed doesn't follow through, it doesn't meet its own imposed conditions, and it doesn't keep the composition of the balance sheet appropriate, the Fed will lose credibility. In essence, like when DeSoto arrived in America and he burned his ships, the Fed's done the same thing. It can't go back now. It now has to follow through. If it doesn't solve the liquidity trap, hopefully in cooperation with the people in Washington, like the Fed after the 70s, when the great inflation occurred, the central bank will lose credibility. And that's another reason why you should understand that they won't turn back anytime soon. And in my estimation, it's more probable that they're likely to get more aggressive than return to a normalized balance sheet in the next 5 to 7 years. Okay, so the next question that always comes up when I talk is, how long? How long are they going to do this? So this is a proprietary Bloomberg estimate that I created. And it describes whether we're going through a structural break, as I believe, or a cyclical recovery, as maybe some more optimistic economists believe. Well, let's just do a quick experiment. We're going to grow to around 150,000 a month in terms of the labor force. We're going to assume the labor force participation rate is going to remain constant somewhere around 63.5. And then the major question is, what sort of population growth are we going to see in terms of the labor force, right? Well, if you expect we're going to grow around 1%, which is what we've historically seen, if we move at around 150,000 and the employment population ratio remains constant, we can get to around 7%, 6.5 to 7% in around 3 years, right? Well, it's 2013, that means 2016, right? Hence why I'm fairly convinced the Fed's going to remain at zero probably until 2016. Now, if we're at full employment, but we assume the population growth is around 0.5%. We do have very different demographics right now because of the retirement of the baby boom. We could get there in 1.5 years. So what I think is that somewhere around mid-2014, the Fed starts to pull back on the pace of its purchases. By 2016, we should begin to move away from 0% interest rate on the policy rate. That's if these estimates are correct, we continue to grow at these rates, and we have those demographic changes. Now, if we're in a cyclical recovery, and we assume 5.5% is the full employment rate, you get a very different outcome. You get 7 years and you get 4 years. Neither one of these are very attractive. Both of them represent some real difficult policy challenges. Even if we've had a structural break and we have a higher level of unemployment, implying the Fed moves away earlier because it's worried about inflation, that's still nothing to be proud of at 6.5% unemployment. But if we really do think that our policymakers really do believe that 5.5% is the full unemployment rate, as I think Janet Yellen, who's the vice chair of the Fed, does, and the likely successor to Bernanke, the Fed could be in the market for a much longer period of time. We're talking through 2020. Okay? So when you're looking at the macroeconomic picture and you're looking at the problems in the labor market, simply just generating enough jobs to keep up with population growth, if you intend to close those gaps, the number of gaps that we looked at, the implication is expect more aggressive monetary policy with a likelihood of greater inflation in the medium term. Now, I talked about the problems in the housing industry and what the Fed's doing. This is the object of the Fed's affection. This is what's called the mortgage-backed primary-secondary spread. It's simply the 30-year offer rate minus the MBS coupon rate. And as you can see, that spread, QE1, was around 140 bips 140 basis points. And that's when they started the MBS purchase program. And when we got to QE3 last September, it was above that. And indeed, it's come down to just over 100 basis points. But in order to normalize this spread, it needs to move back to somewhere between 0 and 20. This has to do with the 5.5 million in shadow inventory out in the mortgage market. It's also got to do with the fact that around 1/3 of all first mortgages are either in negative equity or near negative equity position. And I'll show you the chart on that in just a minute. It's very clear. The closer you get to big mortgage originators, the more cautious they get. And I even had a couple tell me that my estimates of the shadow inventory are wildly optimistic. Right now, the banks are doing a fantastic job of managing the steady drip of non-performing assets into the market in such a way that prices are stable. The risk is that there's a problem in Europe, there's a problem in Asia, or we fall into recession. The banks have to begin unloading toxic assets off their balance sheet. Again, this argues that monetary policy is likely to remain very aggressive for a very long period of time, much longer than what's commonly understood out in the market, even among the most savvy and elite market participants. Okay. What the Fed does is it attempts to craft policy based on a series of rules. What you're looking at here is a composite comparison of the Taylor Rule, which was the cornerstone of Federal Reserve policy from 1987 to 2007. That's the blue line. The red line is the Evans Rule. This is the recent policy rule that the Fed's adopted, in which they're targeting thresholds, and specifically the employment threshold. Because this is very difficult to model, what we did was an experiment. We went back and said, if the Fed would have adopted the more aggressive Evans Rule at the height of the crisis in 2009, how large would the balance sheet have become? So when we went back in and modeled the data, what we got was a very interesting experiment. And that red line, and here's how you want to read this chart. So on the y-axis, or the x-axis, excuse me, every 100 basis points on a negative basis equals 1 trillion on the Fed's balance sheet. So you see the red line in 2007, how it starts to move in negative territory? Because the policy rate can't be made negative, in order to remain accommodative, the Fed has to purchase assets. The guidepost is for every negative 100 basis points your model tells you, you should buy roughly $1 trillion in assets. Now, many of you, I think, instinctively understand this because you've heard economists such as Paul Krugman at the height of the crisis say we should buy 10 trillion in assets. My colleagues at Goldman Sachs had a model that said 6 trillion. I had something called a Rudebush rule based on some work done by Glenn Rudebush out at the San Francisco Fed that told me 5 trillion. Well, it got to 3 trillion recently. And as you can tell from negative 800 basis points, the balance sheet, had the Fed imposed a more aggressive rule at the height of the crisis in 2009, would have went to around $7.8 trillion or $8 trillion. And because we've had some growth, there's been some recovery, you can see the logic of the rule. Around 2014, so it should be around $4 trillion. Now, this may seem like madness to most. Most of us were trained based on the lessons learned during the Great Inflation. And indeed, one would think that we'd have major inflation. Well, because of the deflationary impulse that's still working through the economy, largely due to the fall in asset values in the housing industry, and indeed many other industries also, in the near term, we're not likely to have much inflation. And I would think of it this way. In 5 to 7 years, if we don't have 5 to 7% annual inflation, we've got much bigger problems. We've got a much bigger structural problem than what we think, or even what the Fed thinks. So, if the Federal Reserve does not see improvement in the labor market over the next year, if growth does not pick up, they're going to impose a nominal GDP targeting policy, where they're going to attempt to close those gaps through an increase in inflation expectation and a rise in the nominal price level. And you should expect to see a major expansion in the Fed's balance sheet. Now, I know this is sort of what we would call out-of-the-box thinking, but we're in Shakespeare's undiscovered country. There's no precedent for where we're at in modern monetary policy or modern economic history. It's not that the Fed's making this up as they go. The academic work is out there. It's not well known, it's not well understood. In my opinion, they're not explaining it in the best way. But expect to see more of this rather than less of this in the near term. And in fact, if it does work, you should expect to see equity markets move higher, inflation expectations move higher, and a quicker pace of nominal growth. And we'll show you a graph here in a second on what you want to see. I'm going to skip through the rates outlook and get to the inflation outlook. So this is the projected path of long-term and short-term rates. This is a comparison of the 10-year versus a 3-month, 2-year forward. And while this is influenced by Fed asset purchases, this tells you the sort of inflation rate that the fixed income market is pricing in out to 10 years. This tells you that the professionals in this market think that there's a greater risk of disinflation or outright deflation than there is inflation. Hence why growth is likely to remain constrained for a good period of time. One of the good things, the manufacturing outlook. Eventually, this is what will turn the tables. It's what will cause the economy to turn the corner. This year, because we have a historically old auto fleet, and we lost 250,000 cars during Hurricane Sandy, we should expect to see manufacturing conditions remain robust, and auto sales move towards 15 million or remain around 15 million on an annualized pace. Over time, the breakthroughs in 3D printing and the capital that will flow from around the world, I think will reinvigorate our manufacturing base. And you can see industrial production and growth. That gap is already beginning to narrow. And indeed, this is one of the good signs that we see out in the economy. The best sign, though, is the narrowing gap between supply and demand in the oil industry. What you're seeing is this is the 3-month moving average on 1 million barrels per day between supply and demand. And you can see just that gap narrowed considerably since 2008. And again, I would expect that we're at 85%. We're producing 85% of our own domestic energy needs. Within a few years, it'll be well over 100%. This will cause the trade deficit and the current account deficit to narrow, and it will even bolster the value of the dollar despite what the Federal Reserve is doing. This is one of the unmitigated good stories in the economy, and hopefully our policymakers get the hell out of the way and let this happen on its own. Because if they do, things will get better a lot faster, and the Fed won't have to take those extreme measures that they're currently considering. Globally, manufacturing has rebounded since the great Japanese earthquake of 2011. And indeed, the only laggard right now is Europe, but even in Germany, things are starting to look better. And by the way, if anybody wants this presentation, just feel free to email me, and I'll send it to you. We've got no problem sharing the PDF of this work at Bloomberg. Financial conditions. Financial conditions are really improving. I want to show you this chart. This is the proprietary Bloomberg Financial Conditions Indice. The blue chart is the United States. The orange line is the European Union. We will have an Asian Financial Conditions Indices up and running in April, and we're creating more as we speak. For the first time since 2005, on the back of the European Central Bank's monetary policy, financial conditions in Europe moved into positive territory in 2012. When you see these lines, what you're seeing is a z-score above 0 means financial conditions are improving. If the slope is positive, it typically indicates risk on. If the number is negative, it means financial conditions are tightening, and if the slope is negative, it means risk off. This is the first thing I look at every day when I get into my terminal at work. This is the only daily indicator of global financial conditions. We know it works because our friends at Chicago and St. Louis Fed came and replicated it in order to create their own versions of this financial conditions indice. And as you can see, the blue line there, even though we've turned the slope of these lines is negative, that has to do with the non-outcome in the Italian elections and the worry about political risk in Europe. At least in the United States, the financial conditions remain conducive to supporting growth. And this is part and parcel of the long-term recovery that we're now engaged in. Again, this is an incredibly powerful indices. If you go to FCON on your Bloomberg terminal, you can actually see the composition of the indices, and you can compare them against other financial assets. in real growth in the economy. I highly recommend, if you have a Bloomberg terminal, you go take a look at this. Your clients will eat this up like vanilla ice cream on a hot day. One of the things I like to do is to decompose big data. And I like to look at something I call total credit creation of private financial institutions. And what I can see is that things are truly beginning to get better. There's a strong relationship between total credit creation and nominal GDP. It's not what we want, but we're getting there. What this tells me is at least the big firms in the economy and the upper quintile of income earners are beginning to re-leverage up. This is typically what you see early in a business cycle, not 44 months in. Nevertheless, it's what we have. You want to continue to see improvement like we've seen since basically late 2011. How will I know when we've turned the corner? When monetary velocity begins to move in a positive direction. This is a VLOM2 index go on your Bloomberg terminal. This is simply velocity, and as you can see, it's turned over significantly. When I see those lines begin to move up, like they did briefly in 2009 when we got a fiscal stimulus and monetary stimulus at the same time, then we can get a lot more bullish and optimistic about the fundamental nature of the economy. Does this mean I'm bearish on stocks? No, I'm not. Actually, you probably want to plow in to equities because you've got the Fed who's going to add $1 trillion to their balance sheet. Second half of the year, the ECB is likely to start its outright monetary transactions. And next year, the Japanese are going to unleash the mother of all asset purchase programs, where their central bankers are pledging to meet a 2% price target from a negative 1% deflation rate. The world's going to be awash in liquidity. And it's going to be moving into risk assets, simply because what the central banks want to do is to move investors out of their preferred habitat. Short, guaranteed, non-risk financial instruments, which are largely government securities, into equities in order to begin to try to create a huge wealth effect. And we can argue that that hasn't worked as planned, but that's what they're doing. And indeed, for my money, that's what's causing the moves in the Dow Industrials averages and the S&P 500. The primary cause is central bank policy, not necessarily recovery in the fundamental economy. Housing. We're doing much better in housing. You know, during the bubble, we built about 4 times as many single-family residences as we did multifamily dwellings. And as we've seen a recovery in the job market, an increase in household formation, and the movement of millions of people from homeownership to renter status, there's real organic demand for multifamily dwellings. So we're seeing a great move in housing starts. We're moving at around 850 to 900,000 on an annualized pace. I think about 1.3 million is the steady state equilibrium in housing starts. I think we've lost some capacity there. Others think 1.5 million. Nevertheless, we're going to move there probably in the next 24 months. We should continue to see residential investment play a larger role in the growth story. Housing will never be 6% of overall growth, overall GDP every year. If we're between 2 and 2.5%, maybe 3%, we're doing pretty darn good. What we want to see is that orange line begin to move up. Single family starts. That's going to be challenging because we have to work through the excess supply of single family residences that are on the books of the banks. When we begin to see that move match the line of confidence of the National Association of Home Builders, then we're really turning the corner. Now the challenge here, and this is the policy challenge, is the number of homes that are either negative equity or near negative equity. 22.3 million first mortgages are in negative equity position. 4.7 million are in near negative equity positions. It's roughly about 25% of the overall first mortgages. What that means is that around 100 million people aren't able to take advantage of the historically low interest rates. Sometimes I think we're hypercritical of our policymakers, as we should be. But I think we need to put what they're doing in a greater context. they moved initially to prevent another Great Depression. I would argue that they were successful. Now they're trying to reflate an economy that's still stuck in a liquidity trap, primarily due to the charts that you've seen. Now they're going to try to explain to the American public and the policymakers why they need to follow through. And I want to end on this note. In 1937, Franklin Roosevelt Federal Reserve thought they were out of the Great Depression. They raised interest rates and started to move towards a balanced budget. That threw the economy back into a depression. In 2000, Japan thought it was moving decisively away from deflation, and they began to tighten rates and tighten fiscal policy. Again, it threw them back into the deflationary abyss. By nature, I'm somewhat hawkish. As a matter of fact, on Wall Street, back a long time ago, I was considered an inflation hawk. And I believe in low taxes and smaller government, but we're stuck in a liquidity trap, and the conditions are such that the traditional monetary playbook, the traditional fiscal playbook probably has to be thrown out the window, and the policymakers have to be allowed to move through the next couple of years in order to really be sure that we've moved out of danger. Because when you see this data, I hope it's eye-opening. It should tell you that things are better, but they're not where they need to be. And there are tremendous challenges that have to be surmounted before we can begin to normalize policy, i.e. move towards a Treasury-only balance sheet, and really begin to make the long-term adjustments on entitlements, spending, in order to put the fiscal path on a sustainable footing. Now, I know for some of you this must have been a little bit of a downer, but let me leave you with a good note. I see Chinese companies setting up production facilities here in the United States to take advantage of energy cost, to take advantage of an educated population who produces commensurate with the wage that they earn. There are good things that are happening here. And I think 10 years from now, when we're behind this, we'll look back and say, it was a difficult time, but we're glad we got through it, because on the other side of this, there will be prosperity, there will be growth, and there will be a time when we can say, we're better off not relying upon easy credit and overconsumption. Thank you. So what I want to do is open it up to questions if you have some, or anything somebody wants to discuss, or anything anybody wants to object to. Yes, sir.
It seems to me the risk of this type of policy mix is that you'll get growth, you'll get nominal GDP growth,
Yeah.
but maybe no real GDP growth.
Yes.
In other words, just lots of inflation.
Right, that's it. Okay, so the gentleman made a point, for those of you in the back who couldn't hear, said the risk to the current policy mix is that you're going to get nominal growth. You're going to get a quicker pace of growth, but the risk is it'll just be a lot of inflation. After World War II, when we ran up the massive debts, we had a period of financial repression where the federal government sat on financial markets, low volume, light trading, no financial innovation, and they wanted inflation to pare down the value of public and private sector levels of debt. Essentially, that's what's happening here. Now, it's a little bit different because we've got a globalized economy, you've got linkages, and you've got spillovers, right? But that's when I said earlier, think of it this way. If in 5 to 7 years we don't have 5 to 7% inflation, we've got a much bigger problem. I would say that that's probably about right. The risk is that we don't get 7% inflation, that it's 10 to 15% we got in the 70s. And I think that our policymakers are cognizant of that. And I would readily acknowledge that is the major risk.
Two parallels that you cite, Japan and the U.S. after World War II. Both situations you had vast amounts of savings on the part of the public. We're not coming, this is not our situation. We're coming out of this with very little in the way of savings on the part of the public.
That's right. The saving rate's going to have to increase substantially over a short period of time. That entails a greater adjustment in the household. Specifically, we're not going to move back to 2.7% rates per annum in consumption that we saw prior to the crisis anytime soon. If we get to 2%, I'll be quite pleased from the 1.5% we've seen. But we're going to need to increase savings at the point at which real wages begin to turn up decisively. Another question. You have a question, sir?
You don't mention anything about fiscal policy.
Okay, well,
of course, economists can, but you're assuming that there's no stimulus from the fiscal side.
Well, that would be beneficial if we had stimulus from a fiscal side. So I talked about it lightly in terms of what the fiscal drag is going to be this year. I'm assuming we're going to have fiscal gridlock for the next couple of years, and until we have a decisive election that turns the government in one direction or the other, fiscal policy is going to be a net drag on growth for a good period of time.
I would ask you one other question, is there any data that you've seen showing the number of Chinese companies or potential employment that they've created by investment in the U.S.?
Unfortunately not. What we're seeing is, I'll use ThyssenKrupp rather than a Chinese example, because they've got a global economy of scale. They're setting up these big factories that are essentially robots. The people who work in the factories tend to have advanced education, IT or engineering degrees, degrees in supply chain management from elite business schools. Is the nature of employment in the manufacturing sector is changing profoundly. We're not going to have the great big guy who lifted a few too many weights in high school wearing a hard hat building a car. It's just going to be a little bit different than that. But that's good data sets. We're talking about how to construct them and how to create time series so we can monitor that. Now, in fiscal policy, real short, the solution to the fiscal cliff and sequestration should reduce the deficit by about $4 trillion over the next 10 years. And that's not sufficient enough to put the primary budget deficit, that's the budget deficit excluding net interest owed on the national debt, on balance. The first step is to get the primary budget deficit in balance. And then we can begin to move on the larger issues of the national debt. My sense is that Paul Ryan had it right. We ought to do this over 30 years and give the young people between 18 and 50 a chance to adjust. That doing it immediately vis-a-vis a good old-fashioned Austrian austerity program would be counterproductive and likely send the unemployment rate higher. That things are so far gone that this is going to require a degree of cooperation and coordination at both the state and federal level and between the two parties, that we're going to have to hash this out first. But the primary deficit is the thing that has to be brought into focus. And we need about $500 billion or $5 trillion, $500 billion a year over 10 years or $5 trillion over 10 years. Other questions? Yes?
A couple questions. First, do you think there's, an upper boundary in terms of what the Federal Reserve is comfortable with in terms of what the balance sheet could go to? And then secondly, once the balance sheet peaks, what are the implications on the other side when, if rates are moving up? Are there mark-to-market losses that could be a big issue? And what do you just kind of think of some of the consequences once it's peaked?
The Federal Reserve is split. The upper boundary depends on which of them you're talking to. The academic, more dovish faction probably doesn't have a problem moving to 8 to 10 trillion on the balance sheet. The practitioners, people like Richard Fisher down in Dallas, they don't want it to get any bigger. There are academics who have very significant objections to this because of the risks of creating asset bubbles, specifically in the fixed income market. These are all well-founded. I think that what it comes down to is, do you believe the economy is possible? Do you believe the economy can be caught in a liquidity trap? If you do, well, you're going to lean towards a bigger balance sheet. If you don't think the economy is capable of being caught in a liquidity trap, that's Keynesian nonsense, then you probably have a different view. In some ways, it is somewhat theological in terms of your belief systems, how the economy works, how financial markets work. Okay, in terms of the losses on the Fed balance sheet. Okay, from an economic point of view, those losses are they don't matter. The Fed may take paper losses on some of the mortgage-backed securities, and they'll simply just get indemnified by the Treasury, right? I'm convinced the Fed's never going to sell those Treasuries in the market. They're just going to hold them to maturity. Now, The problem isn't economic, it's one of optics and politics. If at a time when we're raising taxes and the Fed might show paper losses on its mortgage-backed security holdings, it could get very difficult in Washington. And I don't want to discount that, because that could bring the whole thing to a grinding halt, and we can get thrown right back into the drink. So these are very real risks, and I'm very happy that the Fed's openly acknowledging them and talking about them. And that's key, is they have to get out in front of this and explain it in a rational way, at least to the extent that they can, or the recipients of the explanation are willing to hear it. Other questions? Yes, sir.
It seems like the Fed and the government, they're really afraid of the business cycle, and they're afraid of just a good old-fashioned recession. Can they really repeal the business cycle?
They can't repeal the business cycle, and I think we had a historic recession. I think what they're worried about is a depression where prices get stuck. For many of our elite policymakers, the operational lesson isn't necessarily the Great Depression or the Great Inflation, but what's going on in Japan. When I go out and talk to economists of different theological stripes, some will say, well, why don't we just let prices adjust? We'll have a cathartic cleansing, rates will rise, stock will be liquidated, and the economy will reset. Well, we sort of did that in the Great Recession. The banks were forced to take huge write-downs. We had huge losses. Detroit had to go for a bailout. And we haven't had the cathartic cleansing. I would have thought at the time that we would have had a much more vigorous balancing growth after the liquidation of stock that we saw between 2007 and 2009, and we haven't. The operating principle right now is avoiding being caught in a long-term deflationary trap, where you end up like Japan, where you have where prices continue to fall, consumption is put off, and you have very slow rates of growth. The problem is when the Fed imposes these policies, it has significant distributional effects. First and foremost, for the baby boomers who are entering retirement, it's completely killing their investment strategy, right? And right now, they're going to bear the burden of adjustment. They're baby boomers. That doesn't bother me. I sort of blame them for this. But that's, when you impose this sort of policy, you're going to have distributional consequences, and they're going to be uneven. And indeed, one, I think, could fairly say that the Fed wants to ensure that the business cycle continues longer than it might otherwise. And I think that's a fair statement. You had a question, sir?
Yeah, I was just going to ask, with all the money printing...
okay, first of all, it's not money printing. This is not money printing,
expanding the balance sheet?
No, this is not. No, if they go to nominal GDP targeting, that'll be money printing.
Okay.
Right now, they're just buying assets. Some of it's being used to speculate in commodities and oil markets. The rest is being redirected back to the excess reserves at the Fed, which I think are about $2 trillion now.
Okay.
And so we're
you
not,
do read that all the time, though.
No, we're not.
Money printing.
I know. No, that's fine. It's fair. But just to,
okay.
I'm a card-carrying economist.
Okay.
It's
Yeah.
not money printing, and when it is money printing, you will know it's money printing. Let me tell you, you really will know.
Okay.
Dollars will be falling from the sky out of those helicopters.
All right. Okay. Well, with the very accommodating policies, you
Yeah.
think gold might be doing better, with all the inflation expectations down the road, but it hasn't. I was just wondering if you had some comments on gold.
Sure.
And eventually, is this...
Okay, so I think everybody should have gold as part of the portfolio. The reason why, in my assessment, the reason why gold is not performing the way in which some might expect is because we don't have a problem with inflation expectations. As a matter of fact, the Cleveland Fed's version of inflation expectations, which is my preferred version, tells me we have disinflationary expectations. That we're expecting very low inflation for a very long period of time. In my opinion, silver's probably a better play because silver's got productive uses whereas gold doesn't. What's going to go on in Brazil and India and the rest of emerging markets, because they have clean balance sheets, or at least better balance sheets, their growth will continue unabated regardless of what happens here. So you're likely to get a better long-term play in silver. Now, should inflation expectations actually begin to move decisively higher, then you might see gold run. But right now, I think the elite investor is more worried about disinflation than inflation. And that, I think, is the answer to your question. Other questions? One more, yes.
Do you worry about the end game in Japan? I mean, they're looking for higher inflation, which results in higher rates, and they can go into a vicious debt spiral.
Okay, so I've been working in the financial industry since the early 1990s. And this has been the white whale, so to speak. Right? It's Moby Dick.
Surface though.
We're all Melville. This has been the great trade everybody's been looking for. I think we're closer to it. I think the demographic trap that the Japanese are now caught is likely to result in a dislocation in the Japanese economy. I think that what they're planning to do with the BOJ and the Abe government in Japan will probably cause the yen to depreciate sharply. And you might get that trade eventually if that policy does not gain traction. I know several big name hedge fund owners are now actively pursuing that trade. And I think it's about as far as I want to go on that one. Okay, that being seen, thank you very much, everybody. Have a good afternoon. Indeed, it was good to speak with you.
Good job.
Thank you.
Impressive.